Hello, thank you for joining us for the 20th Annual Celebrate Invention at the University of Michigan. I'm Mike Sarathakis, Director of the University of Michigan Venture Center and Managing Director of the Accelerate Blue Fund. This final session of our Celebrate Invention Week is Angel Investing, How to Get Started, presented by Serena Glover. Before we get started, I'd like to run through a few housekeeping details. This webinar is being recorded, and as a registered participant, you'll be receiving a link to the video recording, as well as a PDF of the presentation deck. If you have submitted questions during the registration process, thank you. If you have questions during the session, please make use of the Q&A feature, and we will monitor the Q&A, and Serena will answer questions as time allows. I would also like to remind you that attendees of the webinar cannot see each other. You'll only be able to see the speakers. This is the final session of a series of panel discussions, presentations, and conversations that U of M Tech Transfer is delivering as part of the week-long University of Michigan 20th Annual Celebrate Invention. The university has made amazing progress in commercializing research over the past 20 years, and I'm pleased to share, and as potential investors, you should be interested to learn that just in the past 3 years, U of M has launched 74 new startup companies in life sciences, physical sciences, and software. This entire portfolio of U of M Tech Transfer startup companies has raised over $1.7 billion in venture and angel capital financing during the same time period. These metrics put Michigan as one of the top 5 university commercialization and startup universities in the country. And behind these numbers and the associated successes are untold hours of hard work in refining the research and technologies, developing products and services, mapping out startup value propositions, and pitch decks. So many pitch decks. So we're excited to bring this presentation to you on the art and science of becoming an angel investor, a critical piece of the startup puzzle to the growth in the state and regional entrepreneurship in Michigan. Our hope is that this presentation will help you better understand the risks and rewards of angel investing, but also the impact this kind of investment activity can have on our entire community. We need more angel investors willing to take these type of investment risks in Michigan. We need more investors in Michigan with diverse and dynamic backgrounds and experiences to do this work. And without a doubt, we need more angel investors and entrepreneurs like Serena Glover in our state. So a little bit on Serena before we get started. As you may already suspect, Serena is someone that likes to break down barriers in academia and industry, entrepreneurship, and investing. She has a tremendous impact in these areas in Seattle, Washington, where she lives, but as well as across the country. And without a doubt, even with the distance from Seattle to Ann Arbor, Serena bleeds maize and blue. She is an incredible supporter, advisor, and mentor to me and the entire tech transfer team over my past 6 years at U of M. She's played a critical role in helping us launch the Accelerate Blue Fund, a new $20 million early stage venture fund the Tech Transfer Office is currently raising through philanthropy. As future angel investors, you will want to know about the fund, and I invite you to reach out to me anytime to get an update on where things stand with the fund as we raise it. Serena will share my contact information at the end of her presentation. Serena has been an incredible advocate for this initiative, but also a very tough and fair critic of the concept in the fundraising pitch. Her insights have come from seeing maybe hundreds, maybe thousands of pitch decks, and has helped us refine our value proposition, leading us to a compelling pitch that has led to results. With Serena's help, we've raised over $1 million in the past 8 months, which, as you may have noticed, was not an ideal time to start a new fund. Nevertheless, donations have come from alumni, friends of the university, as well as our first major donation to U of M from Amazon. Now, to Serena's experience. She is an independent angel investor and board advisor to startups in mobile, cloud service, consumer, VR, and AR companies. In 2004, she co-founded Twango, an innovative consumer media sharing website and technology platform. She negotiated the acquisition to Nokia in 2007 and then became director of communities at Nokia, where she ran global organizations leading the effort to bring media-related web services to mobile devices. Prior to Twango, Serena spent 9 years at Microsoft in various management positions where she led product teams, managed websites, and helped complete several corporate acquisitions. And during the 1980s, Serena was part of a research team at U of M that built some of the first database and graphical design tools, working with enterprises worldwide on redesigning large-scale real-time fail-safe systems. Serena received a BS in computer science and an MBA from the University of Michigan, and she also serves on the Tech Transfer National Advisory Board, lending her experience and insights to help us continually improve the service we provide to the community at the University of Michigan. I am very pleased and honored to welcome Serena as our final presenter to this year's 20th annual Celebrate Invention session. And with that long but well-deserved introduction, welcome, Serena.
Thank you very, very much, Mike. I really appreciate the kind intro. I'm super excited to be part of Celebrate Innovation Week. I've been part of it the past few years, and every year it just keeps getting better and better. So, okay, here we go. We're going to talk about angel investing. I think I typically do this session interactive, or I'm in the crowd talking to people, so this is a bit weird. I'm sitting here staring at myself, which is no fun, but I'm going to hope that you guys all haven't gone to dinner there in Michigan, and there's some folks listening in. You'll see that they just put a poll up on the screen. If you happen to be at a device and you can that you can answer, it'd be great to know. We're just trying to figure out, how many of you guys are like never invested before and want to get started, or have been doing investments but are interested in learning more. And so we'll get a sense from the poll, kind of who's in the audience, which is super helpful. This pitch is mostly going to be come from the perspective of you've never done it before. So, if you've done it before, some of the stuff may be old news, but some of it might be new too. So who knows? Okay, so next slide. We're going to cover a lot of territory today. In fact, I have way too much content for an hour and a half. So I'm going to have to really giddy up here. So think of this as a survey. I'm just going to go through a lot of information, introduce you to some terms, some concepts, and so on. At least will give you an idea of what you need to think about if you're going to start angel investing. And obviously the web's full of information. The Venture Center's got tons of, there's a bunch of Michigan resources at the very end of this that will be in the slides, which, by the way, you'll all get the slides. So you'll have all of this information. I am going to try to answer questions along the way and at the end, so please feel free to put your questions in there, and I'll do the best I can to get to it. It looks like so far a lot of the people, there's quite a few. I'm just looking. So far, more people have not invested than have invested, but it looks like we got a mixed crowd. So, okay, so we're gonna roll here. Next slide. So Mike, again, thank you for the introduction. I put a little bit of my background here just because it's important to understand where I'm coming from. Angel investing is part art, part science. A lot of it gets informed by the experience of whoever's doing the angel investing. So it's helpful to know what the experience is of the person who's doing it, because it'll help you sort of put the filter on for what I'm going to tell you. So as Mike said, I came out of research originally, had a startup. Then I was at Microsoft. At Microsoft, I did some M&A work, so I got to experience what it was like for small companies to pitch a sale to a big company. So that was another form of essentially investing, if you will, in terms of acquiring companies. And Microsoft in the mid-90s was on a frenzy for that. And then once at the late stages of Microsoft in the late 90s, I started investing. I had absolutely no idea what I was doing. It was just people were piling out. There was tech bubble, everybody was super excited about starting companies. And I just started writing checks, not knowing a thing about what I was doing. And so, of course, I made a bazillion mistakes. But that's part of getting started. You're going to make mistakes. And then I went to Nokia, and then after that, in 2008, I started really doing this full time because I just discovered that I really love doing it. I love working with early stage startups. There's a tremendous amount of impact that you can have working with early stage companies, and it's a lot of fun. So I'm Seattle based. I mostly invest on the West Coast. I'm software tech, mostly a little bit of hardware. I don't do clean energy. I don't do bioscience. So if you're in life science, bioscience, I'm sorry, most of my examples are going to be software tech today, but most of what I think I'm going to tell you is going to apply no matter which areas you're interested in investing in, potentially. I invest in a lot of different business models, and from consumer to B2B, SaaS, enterprise, and so on. And then another big part of my portfolio thesis now is, does the world need another one of these things? And that's my way of saying social impact invest. I really think about, what is this thing? Is it going to change the world? I only invest in diversified companies now. I've gotten much stricter about that, in part because morally, but also because they have better financial returns. I mean, that's been proven data-wise. So again, what you're going to hear from me today is based on all of those experiences, and there are no absolutes. It's mostly my opinions on what I've seen over the years. Okay, so next slide. Well, I'll start out with, there's some definitions. So if you're going to get into angel investing, there's a few things that you need to know. First of all, what is an accredited investor? You have to be an accredited investor in order to angel invest or to do any kind of investing like this, venture investing. And so if you're a trust, you have to have more than 5 million in assets. If you're an individual, you have to have $1 million in assets, including your home, excluding your home. And you have to be, or you have to be an individual that makes 200K a year or 300K combined with your spouse for at least 2 years with ongoing expectations. And the reason they have these rules, it's the grandmother rule. They don't want early stage risky startups going to, Grandma Suzanne and getting money from her when she doesn't really understand the risks of this and doesn't have the financial wherewithal to do this kind of investing. Second thing you need to understand is there's a big difference between a startup and a small business. And this is where it's really easy as an angel investor to make mistakes early on. So startups basically are companies with they have an expectation of exponential growth. In other words, they're venture scale. The expectation is they're going to raise a bunch of money. They're going to go out and really grow this thing. And ideally, they're going to exit at some point with either an IPO or an acquisition or a merger or something like that. So that's the whole idea of a startup is that it's going to get big and it's going to exit and there's going to be a return on the money. A small business is just a small business that could run forever and doesn't really have those expectations of growth. And so they're not, from an angel investing perspective, what you want to invest in, because you're looking for companies that are going to grow and return. And part of being an angel investor is figuring out, when you're looking at something, whether this looks like something that's just going to turn into a small lifestyle business potentially, or whether it's something that really has the potential to be venture scale. And then there's the last thing is, what's the difference between an angel investor and a venture investor? Angel investors are venture investors. The difference is a venture capital fund is investing other people's money. So they have a thesis. They have made specific decisions about what they'll invest in, whether it's industries, geographies, business models, or whatever, where they invest, if they have geographic scope, and how big of checks they write, all that stuff. Angel investors are investing their own money. And, I always say it's great because you can do whatever the hell you want as an angel investor. You can, but that's both a good thing and a bad thing. I mean, you can get yourself in a lot of trouble because you're kind of investing your own money. And if you see something that looks really cool, it's like, well, that looks cool, I'm going for it. But the reality is, and I'll talk more about this later, I mean, it really helps as an angel investor to have some kind of a thesis, even if it's just your own money that you're investing, because it helps keep you from getting into trouble, which I have done a few times, I'll tell you that. So those are just some basic terms that you need to know going in. Next slide. So this is a super messy slide. Don't try to read it. I apologize. You'll have this anyway. You're going to get this deck. So you'll be able to read it when you actually get the deck. The key thing here I wanted to talk about is, where does angel investing fit in the world? So on the left side of this really ugly, messy slide is for-profit investing, and on the right side is nonprofit giving. So investing versus giving. And then in the investing space, if you're thinking about where do I put my money in the world? On the investing side, on the far left are like public, all the public options. So the stock market, funds, and things like that. In the middle, that big chunk in the middle is private investing. And on the left-hand side of that are all the late-stage private investing vehicles like hedge funds and PE funds and things like that that really invest in later-stage companies. And on the right side of that middle box is venture. And within venture, on the left are venture funds that are later stage, Series A, B, C, D, growth money. And on the right side is seed financing. So seed financing fits in the very, very early stage of private investing, but it's investing, it's not giving. And the reason I put giving on the slide is because if you're out there and you're thinking, hey, I'm investing and maybe I'm angel investing and want to do more, or I'm thinking about starting my own, doing more, starting up angel investing, part of the way you have to think about this is it's asset allocation. Where is that money coming from that I'm going to use for angel investing? And a lot of people will say, oh, well, I'll take some of the money I have in the public markets and put it into seed investing. Oftentimes, though, what happens is it'll come sometimes from money that you would have put in philanthropy. And so I've had, especially lately, a number of conversations with different people who are like, oh, I'm really thinking about angel investing, but, I care about social impact, so all my philanthropy is social impact. And so I can't angel invest because it's not, and that's where I sort of say, stop. Actually, one of the best ways you can social impact invest is through angel investing, seed investing, as opposed to philanthropy. Philanthropy is great. I'm not saying don't give money away, but there's a lot of things that would benefit from being a real company and a for-profit company. And so sometimes for-profit companies can make more impact and make more progress on real ills in the world than philanthropy can. So that's just something to keep in mind if you're thinking about how you're allocating money and how much you're going to put into seed investing. Next slide. So now that we're sort of going to focus on seed investing, let's say you figured out where asset allocation wise, how much you want to put into it and where it's coming from. The next question is as well, how do you get started? Like, how do you physically get into this? And again, you'll see on this slide when you actually get it, it's basically some buckets, different ways to get in, and some information on sort of the metrics for those. On the top left, what I have are funds. So there's a lot of venture funds, early stage seed funds. And so one way to put money in this asset class is just to invest in a fund as an LP, silent investor. You could also go in as a venture investor, a venture partner, where you have an active role. That's one way to put money in this asset class. Moving to the top middle, there's also micro funds and angel fund groups that basically take money and pull it all together, and then they all sit together and work together to make investments. And those are great ways to get in if you don't have enough to be an independent angel investor, but you want to get started and you want to be able to pool your money with other people. Finding one of those funds is often a really good way to get started, especially if you don't have enough money to really go for it as an independent. There are also angel groups, top right. And angel groups are great because it's a place, if you're getting started, you can meet other angels and you can learn. They do diligence together. Usually, not all. Every angel group works a little different, but most of them, it's like they bring in companies every month. They screen them, then they present certain numbers of them, and everybody in the audience can sit and listen. And then they can share diligence with each other, but every investor in the room makes their own decision. So it's not a pooled thing. It's each investor doing their own thing, but you get to share diligence with other people, and it's a great way to learn. Bottom left, the other way to get in is syndicates, and this is great again if you don't have a lot of money, but you're not going to learn as much this way because Syndicates are basically like on angel list where you could find an investor, a really famous investor will syndicate. So if they're doing deals and there's a little bit of space left for some other people, they'll create a little syndicate and you can just put a little bit of money and it all gets pooled together and then it follows whatever investment that person is making. I think the downsides of those are, one, you don't really get to learn as much doing that because you're not involved. And two, often the deals that get syndicated aren't the hot deals, right? It's usually where there's leftover space, which typically, it's not always true, but it's not I don't think the best place to start. The middle of the bottom is crowdsourcing. I put this in here because, not because it's angel investing. It's not. In fact, you do not have to be an accredited investor to crowdsource. But I put it in here just because people know about Kickstarter and Indiegogo and other things like that. And they're like, well, where does that fit in? Well, it fits in that sometimes companies raise money through these things, but typically they're much smaller amounts of money, and they can offer goods or services in return. And the commits are super, super low, like $10, $100, $150. So I don't really consider it angel investing, but I just kind of include it here because people always ask me, well, where does Indiegogo fit into all this? Okay, and then the bottom right is independent angel investing. And that's what I'm really going to talk about today, is what does it take to be an independent angel, at least from my perspective. But a lot of what I'm talking about in terms of diligence and all of those other things are useful if you're investing in an angel group or you're investing in an angel fund or as an LP. Next slide. No questions so far. Okay, just stop me anywhere if there's questions. Okay, so what I'm going to do now is start talking about how to build a portfolio. So you want to be an independent angel. What does it take? So there's a million opinions on this, but generally what you'll hear is if you want to do this, you need to set aside about 500K to $1 million. And you need to do at least 15 deals over the course of like 3 to 5 years. Personally, for me, what I always tell people, $1 million, 20 deals. And the reason why you need to do 20 deals is because this asset class, early stage companies, is very, very risky. And the only way to mitigate that risk is to invest in a fair number of companies. And there's different math on this too. Different people will say different things. You know, I tend to do the third, a third, a third. A third will survive and do decent, you know, second base, maybe third base, right? A third will, you know, maybe make it, maybe not, but you might get your money back or some of your money back. A third will die. And some people will say 50% die. Some people say 70% die. It partly depends on your individual experience and how much expertise you have and how far outside of your knowledge area you're going. You know, I tend to stay with software because that's what I know. That's why I don't do green energy or biotech. I don't know shit about that stuff. So I don't invest in it. And so I think my risk goes down a little bit because I stick with what I know. But you got to plan that a lot of these companies are going to fail, say 50% just for a number. And so it becomes a hits business. Your hope is out of a portfolio of 20 companies, you're going to get one that's just like, boom, out of the park, because that's how you get money. That's how you make your return. So it's important to have a decent number of companies over, like I said, over 3 to 5 years. You don't want to do that all in the first year. You want to do it over time so you can learn as you go. Now, somebody might be sitting in the audience going, oh, that's not how I invest. I mean, I do like one deal a year, and that's fine. There's people who, I know a whole bunch of people out here in Seattle who have money, and they may do one deal a year, and they only do a deal if it's somebody they really know, that they really respect, or it's in an area that they're super passionate about in like their second career or for impact or whatever. And that is totally fine. There's nothing wrong with that. The point I want to make to you though, as you're thinking about what you are going to do, is if you're only going to do one deal a year, your risk profile is going to be way higher because most of these things fail. So if you're thinking about it as a portfolio, like most venture funds do, you need to be thinking about a volume of deals to make it make sense. Check sizes for angels typically are 25K to 100K. Occasionally, you know, like some super angels, like sometimes we'll write a 250K check and lead a deal if it's a big round, later stage seed, big round. But it's usually that 25 to 100K. I tell startups all the time, don't take a check less than 25K. It's just a complete pain in the ass to manage lots and lots of people on your cap table. So if you get too many investors writing all these little itty bitty checks, it's a nightmare to manage. And so most, and there's only rare exceptions to when you might take somebody for less because they're going to be a valued advisor and you really need them or whatever. But in general, if you're not writing 25K checks, you're not in the game of independent angel investing. The other thing to think about is you have to keep a reserve. So what that means is let's say you start with $1 million. You want to think about keeping, you know, some chunk of that for follow-on investments. So my rule of thumb is half of whatever I've set aside, half of it's going to be for follow-on. And again, it totally depends on what your investment style is. But for me personally, I like to follow the winners. So if I have companies that are starting to really show promise, I want in on that next round. So I save money to do that. The other reason you need to reserve money is because often with these early stage startups, they raise a bunch of, you know, they raise some money and they don't get quite as far as they think they're going to get, but they're doing really good and you want them to keep going. You might have to put more money in to keep them going because usually they'll go back to their original angels and say, hey, God, we just need another like 200K or whatever to keep going. So it's good sometimes to have that money to help them out doing that. Now, that's not to say you throw good money after bad. That's the key thing you have to figure out is it worth putting more in? But if it is, you want to have money set aside to do that. I've already talked about success and failure rates, and you're going to get a million different opinions on this, but just know it's a high number of failures. And so in order to play this game and to win and return money back into your portfolio, you got to make a significant number of investments. The other thing you got to really think about is liquidity. And boy, this has changed over the years. I mean, it used to be back in like the 90s, it's like, you put your money in and 2.5 years later, you have it out because, you know, they've grown, they've gotten acquired or whatever, and they're out. And that is not the case anymore. I mean, if you're putting money into this asset class, you better plan on, you know, 10 years to 12 years for some of these companies to get to an exit. Now, the interesting things is if they're going to fail, they usually fail early. So like you'll know pretty quick if a company's not going to make it. But the ones that do stick around, they take a while to grow and get through all the growth stages to IPO. And part of the reason that the timeline on that has gotten so long is so much private equity and late stage venture capital has come into the venture. It used to be there were just venture capital companies. Well, now all these PE companies like Warburg and people and Tiger and Cotu and all these guys are coming into the venture category and investing late stage, which means these companies don't have to IPO. They can just stay, they can just continue to raise funds on the private market. And there's pluses and minuses to that. That's a whole different conversation. But the point here is because of that trend, these exits have gotten farther out. So be prepared for lack of liquidity for a fairly long time. And then the last thing is think about whether you want it to be evergreen or not. And by what I mean by that is if you get an exit, do you take that money and put it back into your fund to reinvest? And a lot of us, that's what we do. We just reinvest the monies that we get back. And sometimes we'll pull a little bit out for ourselves, of course, but we often try to make these things evergreen so we can just kind of keep building our portfolios. So these are just some different things that you need to think about in terms of building a portfolio and the numbers that it's going to take you to really get into this game. Okay. I guess the last thing on this is on liquidity. I didn't talk about secondaries. The other way to get money out is through the secondary markets. And so if a company is not IPO'd, it's not on the public market, so you can't buy and sell the stock, there are these secondary private markets that will buy private companies, stock from private individuals who own stock in private companies. They're illiquid markets, hard to price. You can use them. I've used them. It works great if you've got a really, really hot company that's late stage that everybody wants in before it IPOs. That's where it works really great because everybody comes running for your early shares, and you can get a decent price for them. But if you're relying on secondary markets for liquidity, that's a dangerous game to play because they're hard. They're hard and they're fickle because they're private and there's not a lot of good information. So, okay.
Serena,
Yep.
quick question from the audience. What do you think is a good rate of return for an angel investor if he or she are managing their portfolio well?
That is a super, super, super hard question to answer because everybody's going to tell you something different. Angel investing is very personal. So for myself personally, I'm going for the big hits. I mean, I want a 50x return on the portfolio. Now that's an outsized return, but that's what I'm going for. Other investors will tell you, and I have some friends who are like, I'm just happy if I get 2x because it gives me, I can stay in. I love doing angels. I love early stage. I can stay in the game and I get a little bit of money to keep putting back in. So, you hear some people say 2x, you hear some people say 10x. And then, you have people who are going for the fences. And again, that's on overall portfolio return. So, to get a huge return on a portfolio that has a lot of companies that are going to fail, you got to have at least one that's going to do really, really well. And that's why I kind of call it's a little bit of a hits business. It's why you got to have enough companies in your portfolio to make that possible. But not everybody wants to do that. Some people are happy with a much smaller return. So
great, thanks.
Yeah, it's partly for you thinking about angel investing. What do you care about? and some people use the hedges. Well, I want just as much as if I put it into the public market. So some people are happy to say, I'm happy if I get an 8% return. Different people have different ways to think about what return they want. So it's partly a question of return, but it's also a question of, what do you want your legacy to be in the world? And is this something that you're excited about and helping new technologies and new companies come out into the world? Okay, next slide. I'm already behind. Okay, so there are a million different investment styles in angel investing. Nothing here is right or wrong. They're just different. And so some are a few deals each year to build up that portfolio. Some are spray and pray, and what we call spray and pray are the people that go out and, I had one guy come to me and say, I got $5 million I'm going to put in this asset class. Where do I start? And so, I pointed at him all these different deal sources, and that guy went out and literally burned through $5 million in less than 2 years. Cause he just little checks in a million different companies. Right. And that can work too. So it depends on what you want to do. Some people deliberately allocate. They'll really spend a lot of time on a couple and then just spray and pray on the rest. There's all different ways to think about it. The important thing for you, if you're thinking about getting into this, what do you want? What's your interest? How do you want to approach this space? And so there's not necessarily a right or wrong. Some people write lots of small checks. That's more of the spray and pray. Some people only write really big checks. Some do mixed. For me personally, I do mixed. I go heavy in on companies that I'm super interested in, where I want to be the lead investor. I'll probably take a board seat, Other companies, I'll just be like, oh, that's really interesting, but I don't plan on spending any time with them. It's a $25K check. So it just depends. You have to think about what you want to include or exclude industry-wise. business model wise, geography wise. For example, for myself, I mostly do West Coast, only elsewhere if like a venture capital firm brings me in for something, but I don't go fish in like New York or places like that, because it's too much time on airplanes, and it's hard to fish in a market that you're not physically in, unless you got somebody bringing you in. So that's one thing to consider. Another thing to consider is like, where, what industries do you want to invest in? Like for myself, I don't do biotech. I don't do, like battery technology, clean energy, because I don't understand that stuff. So think about that, because it doesn't mean you can't invest in something outside of what you're thinking about, but it really, really helps when you're doing this to think about, what are the things I care about? What are the things, where do I think I can add the most value to startups? That's another way to think about it, because these guys often need tons and tons of help. And so where can I add the most value? And also, investment impact. And for me, that's really huge right now too. I'm looking really, really, really hard at the implications, the social, the environmental, the impact on human capital, the impact on our, how we measure our natural environment, how we measure negative externalities, all those things I think about a lot, which often leads me to B Corps. Frankly, I think every corp should be a B Corp, but that's a whole nother pitch. But it's that double bottom line, thinking beyond just our old industrial measures of GDP, which is kind of how we measure companies today. And it misses a lot of the human capital and the natural capital and how to value those. So those are things to just think about in terms of what you want to do. And then the other thing you have to think about is how much time you're going to put in. One of the things you have to be careful about angel investing is, boy, if you have expertise, they're going to come after you and try to get as much out of you as you can. So you have to be very clear about how much time you can spend on companies, and whether you want to take an informal role, a formal advisory role, formal board role. And that's a whole separate conversation as well, in terms of being advisors, being board members, what that takes, what that means, what the liabilities are. But think about those things, like how much time are you going to really spend? And then whether you're going to lead, follow, or lead a deal or follow, those things all matter as well, in terms of what your responsibilities are going to be with that company. Okay, next slide. So startup companies are going to present in a whole bunch of different ways to you. And the seed and investment space is a, oh, by the way, I'm going to stop. Somebody had a question, what's a B Corp? B Corps are social benefit corporations, and the way to think about them simply is they have a bottom line profit motivation, just like a C Corp does. But they also have other goals as part of their core fundamental philosophy. So it's like double bottom line. They care about the environment, they care about various other things. And like I said, really every company I think should just be a B Corp, because that's what we should all just be doing. But today, B Corps are set out as sort of a separate category, and they essentially have a double bottom line. Okay, so back to this. They're going to present, these companies are going to present in a lot of different ways to you. So the seed funding stage is pretty wide. And the risk profile is pretty wide. Somebody could present to you with an idea on the back of a napkin or a PowerPoint. They could present to you with a really early prototype in a research lab in the university that's got, no customers yet, but it's a technical concept that they're trying to, something new. It might present as a minimum viable product with a few customers, all the way up to, it could be a company that actually, has got customers. It even might have some revenue, but it's still like hasn't hit the curve. It hasn't hit the growth curve yet. It's still trying to figure out how to get on that growth curve. So they can, or it might be on what you think is the edge of that growth curve and ready to take off. They can present in a lot of different ways. So part of angel investing is when you look at a company, understanding kind of where on that spectrum they fall, because that impacts what their valuation should be. It impacts how much money they need to raise, how much more money they're going to need to raise later, and so on. So getting to the point where you can identify kind of what am I looking at here? Like where in the spectrum of early, quote unquote, early is it? That's really important and you'll get a sense if you're doing this, or if you've already been doing this, you'll get a sense for it really, really fast. Okay, next question. Or next slide, thanks. And I'm looking at questions. Sorry, I'm multitasking here and I'm not good at that sometimes. Question was, is it common for an angel investor to take a management position in a portfolio company? The answer to that is no, that's not common. Occasionally that happens where an angel will step in because they've got management experience. A lot of times that's where they came from originally. But no, not in management. That's typically not where angel investors should be. Sometimes angels are on boards. I often am will help form a board in an early startup and will be the first outside board member, outside of the CEO and maybe the co-founder. So yes, angels often are on boards or on advisory boards. But what happens with that typically is as an early stage investor, typically you might come off boards later on because typically later stage venture firms will want those board seats. And some of the needs of the company by then have changed too, where your skills as an expert on getting companies from 0 to 1, as opposed to 1 to N, those are very different skills. So, you may end up focusing on board seats on companies in the 0 to 1 space. Okay, so funding stages and naming confusion. So I guess the point I'm going to make here is early stage funding has lots of different names. They're called friends and family rounds, angel rounds, pre-seed, seed, seed. It changes all the time. And it changes in the markets. Like pre-seed was a Silicon Valley thing and nobody in Seattle had ever used the term pre-seed until all of a sudden it was a Silicon Valley thing, right? Institutional seed means there is a seed venture fund involved or a family office or some fund. If there's a fund involved, then you have an institutional seed. Otherwise, you might be anywhere in the seed 1, seed 2, angel round, whatever you call it. Now, on the one hand, don't get too hung up about these terms. But on the other hand, these terms do matter. And depending on what market a company is in, like if they're in the Valley versus here, they have different metrics for whether they're, an angel round or a friends and family round or, late seed or whatever. And so companies will present and say, I'm raising a Series A, for example, but they don't have Series A metrics. And when you see that, you're just like, oh boy, they don't know what they're doing, right? So these names do matter. But it's not like every single one of these terms has a specific evaluation number attached to it. They don't, and they're used interchangeably. Okay, next slide. Deal flow. So the other thing that you have to think about, well, where are you going to get your deals from, especially if you're just getting started? Well, the good news is there's actually lots of places to get deal flow from. And the best thing, well, if you're connected up. So for example, like if you're, a U of M or a U of M alum, I assume there's a lot of U of M people on this call, the U, that's one place, obviously. So go to the places, like the companies you've been in, the universities you've attended. Those are places, to get connected, to find deal flow. Find other active angels. That's the #1 best thing to do. Like when I got back into this, I started out in the late 90s, just had no idea what I was doing. And then I stopped while I was building my own company. But then in 2008, I went back at it again and full time. And when I did that, I was like, okay, who are the 3 people, guys, they were all men, of course. Who are the 3 guys in Seattle who really know what they're doing? And I just hitched my wagon to those guys to figure this out. So that's a great way. There's lots of, it didn't used to be these when I started, but now there's all these accelerators and incubators that are pumping out startups all over the place. The examples I have on here are Seattle examples. I've got a bunch of Michigan resources at the end, but Michigan's going to have this as well. There's all kinds of different groups, at least like in Seattle, and I'm sure in Michigan it's the same. We've got the Female Founders Alliance. It's this huge organization that's now national, but it started in Seattle. And, they're all women CEOs, and there's tons of them, right? So that's the source. I look, I fish in that pond. Referrals from entrepreneurs, like if one entrepreneur has done great and they're recommending another one, that's always a good sign. I work with a lot of the VC firms, so they'll bring deals to me and they'll go, hey, we're doing this deal and we need somebody, to help these guys with XYZ. Can you come in and help these guys, and would you be interested in investing? And I always say, well, I won't do it unless I can invest, because I want to leverage my time. But that's a place. There's corporate venture groups, family offices, and also are always deal sourcing. If they're focused on this asset class, not all family offices do that. Angel groups we talked about earlier. Attorneys, surprisingly, I get a lot of leads from attorneys, because early stage startups go to attorneys to get their incorporation paperwork and to get their deal docs done. And then the attorneys will forward those companies to the angels in town. So, and then research groups, and obviously, Michigan, again, great example of just, I'll come talk to that later, but a phenomenal amount of research coming out of the U. And conferences are another great place for deal flow. So the thing is I'll say is, it may seem scary at first if you haven't started yet, like, where am I going to find deals? But I can guarantee you, if you get plugged in, you network, you go to a few conferences, you talk to a few people, you will quickly get to where you have so much deal flow you don't know what to do with it. And the key is getting the good deal flow. And that's the trick. And figuring out who are the right people to follow, and where are the right sources to get the really good deals coming out early. Okay, so next slide. I'm just going to answer. I'm going back to questions for a minute. There's another question that popped up. There are so many variations in returns. Do you sometimes get back the principal with some return, if possible, and then walk away? I'm not sure I'm going to answer this. I'm not sure quite what the question is, but let me take a stab at it by saying, usually with startups, it's binary. You either are in and the company continues to grow and eventually you get your money out, like if it IPOs or if it gets merged. And sometimes you might get your principal back, and which I consider kind of a, first base return. Sometimes you may get a little bit back with it, or sometimes you may get a lot back with it, but usually you get a return and you're out and you're done. The thing is if a company, there's no walking away. I mean, if you put your money in, it's in until they exit. The only way to walk away on an early stage company is through a secondary. And again, those are hard to get, especially if a company's not doing great. So it's kind of a, you're in until you're done sort of scenario. And if you're in and they keep raising money, then the question just becomes, do I keep putting money in? And that's the whole, you have to make that evaluation every single time that they raise a round. Do I want to put more money in? Okay. All right. So diligence, this is a really, really important part of an angel investor's job. And again, I'm going to throw a lot of stuff out here. It might seem scary, but just keep in mind that usually you're doing this with other people. And I strongly recommend, if you're doing it, to find somebody to work with and do angel investing with, and ideally hitching on to somebody who's done it before. But what you're looking for, the first and foremost thing you're looking for is, are these the right people? Because at this stage, early stage, you don't have enough information about product and customers and growth rates and acquisition costs and all that stuff to look at it and evaluate it as a business. If there is that information, it's not early stage. It's later stage. So you're often looking at it and going, do I believe this woman or this man or these people? Do I think they can pull this off? So it really comes down to people. And I will tell you for myself that the biggest mistakes I've made, and I've made a bazillion mistakes over the years, but the biggest ones have been not doing enough people diligence and getting sucked into an idea that I thought was so cool. And oh my God, this is going to be huge and massive market. And, I'm rah, because it's something I'm passionate about too. which is great to follow your passion, but it's dangerous because sometimes you can overlook the little red flags about the people. And if you don't have people who can execute, you're screwed. So pay attention to the people. Second thing is this a real problem? There's so many people that build solutions to stuff where there's not really a problem, or the problem isn't big enough that people are going to be willing to pay for it, or the problem isn't big enough and bad enough that they're willing to switch off of what they're using today to solve the problem onto this new thing, because switching costs can be the death of companies too. So you have to really know that understand that there's a problem, and then you got to care about it, because if you're investing in things you don't care about, you're going to ultimately probably not enjoy it as much. And you're also more likely to make mistakes, because if you don't really care about it, you're not going to really do the diligence or really understand it. And you're probably not going to add as much value to the company either. And ultimately, early stage, that's what a lot of companies are looking for, is investors that can add value. So care about what you're investing in is, I guess, the point I'm making, because that'll help you be a better investor. And then you got to believe that whoever the solution is designed for is going to buy it, is going to want this thing. And so it's not whether you would use the product, it's whether the identified buyer would use the product. So that's something you got to really believe, because if you don't believe that, it is probably not worth investing in whatever the thing is. And that doesn't mean the product has to be totally built out. You know, the solution has to be totally built out, because obviously that's, in fact, one of the big mistakes. Can't build everything at once. You got to start small, but you look at what the sort of the first step, what is being built, and going, do I believe this solves a real problem? Is it done in a way that people will use? Do I believe the buyer will actually use this thing? And then you got to figure out, of course, is this big enough market to matter? Like, is it venture scale? Because there's a lot of cool things that get built for really niche markets that there's not a big enough market to bother as a, you know, for venture money to make any sense. So that's the other thing you got to really look at, is how big is this opportunity? And then capital. Where is the money coming from? How much are they going to need? And you got to think not just about the round that's being raised right now, but about all the future money that they're going to need, because there's usually in venture, you know, the expectation is they're going to raise a whole bunch of money over time. And so it's not just about now, it's about the future as well. And where's that money coming from? And who do you want to be on a cap table with? And that's the other thing I would tell you as an angel, that it matters who's on these cap tables. And, you know, there's certain people, like, I won't invest if they're in the company, because I know what they do to companies. You know, they screw them up and whatever. So you really got to pay attention to who the investors are around you that are in this company. That matters, because it's going to impact how you can work together with people to help the company move forward. It's going to impact the advice that the company gets, and whether that advice is good or not. So if there's somebody that you think gives really bad advice on you know, the lead investor on the company, you probably don't want to go in. Okay, so those are kind of the first round of things I really look at. My gut, right people, real problem, I believe in the solution, and this is a big enough thing to care about. Then the next meeting, next slide. Before I get into the next slide, I'll just answer the question, how do you look at first-time and diverse founders if people in their experience, I'm not sure what the wording is, how do you look at first-time and diversity? Well, so just because you're a first-time founder doesn't mean you aren't going to be a great founder. So obviously, if somebody has a track record of having built a bunch of companies, of course, that gives them some credibility, and you know that they've learned their lessons and they've made some mistakes. But just because they've been successful the first time doesn't mean they're going to be successful the second time. And trust me, I've done that. First time was great. Second time, ooh, not so great. And it wasn't so much about the person. It was more about just the environment and a lot of things. But anyway, so just because it's a first timer, it doesn't mean you discount them. And diversity, for me personally, it's super important. I only invest in diversified companies. And I believe in that strongly for a whole bunch of reasons, but partly economic reasons. They just have better returns. And there's a whole bunch of reasons why they do. So I look super hard at that, because I'll tell you, it's super hard to change that and to tack on diversity later. Like once a company's kind of established its culture, it's very hard to change. And anybody who's worked in a big company knows that, right? Or if you've been female or of color or whatever, and you've worked in a big company, you know how hard it is for those companies to change. So I look at these companies right out of the gate, making sure they're diversified, because that's in part how we're going to change the world. That's part of my social, my impact theory, is we have to build diversified companies because that'll help us build better companies. So, okay, due diligence. If you're still interested, there's a whole bunch more work you have to do. And there's a lot of questions you can ask, but obviously, you know, team, you want to get as much information as you can about them. And I can't stress this enough. It's like, find out everything you can find out. If they've got some customers, you know, find out how what the customer's feedback has been on the product to date. And what, you know, whether they think this is something they really want or not, or if it needs changes, what those changes need to be. So getting a little bit of diligence on, you know, is this problem really real for these customers is helpful. You have to look at the product itself and go, does this thing make sense? And how much more work is it going to take to get it really to where it needs to be? So that's key. Business model's key. And this one is, I can't stress this enough. So many startups come in with the wrong business model. They don't understand like what the dynamics are of a given business model and what the metrics should be for that business model. So for example, you know, I had one that recently that was like, okay, they tell me their enterprise solution. Okay, so enterprise, great, fine. That means that you're going to sell to big companies. Your sales cycle is probably 9 to 12 months. And you better have a price point that supports a few number of large scale sales every year. And it turned out that this thing had a price point that was like an app. And I'm like, well, that's not an enterprise, you know, that's not a price for that's not priced for the enterprise sales model. So something's not right here. So, you know, that's one example. Another example, and again, I'm sorry, these are all software examples, but, you know, early stage, I do a lot of two-sided marketplaces. Early stage marketplace, we were out fundraising. I was helping a company fundraise. And, you know, there's a lot of enterprise investors in Seattle because, you know, Microsoft, that's where, you know, that's sort of the core DNA here. And they're all like, you know, revenue, where's your revenue? And I'm sitting there going, no. In a two-sided marketplace, the most important thing early is liquidity. It's like, you got to get a bunch of buyers and a bunch of sellers, and you got to get them transacting. That is what matters. And then you figure out how to monetize them. And so, you know, figuring out what the right KPIs are for the right time for the point in the life cycle of a company is super, super important. And often CEOs will come in not fully understanding that, especially if they're deep tech. They're coming out of technology and as opposed to out of sales and marketing. And also you'll get bad advice sometimes from investors, you know, like we sometimes give companies the wrong advice. So that's something you got to be hyper aware of when you're looking at companies and figuring out whether they understand that or not, or whether you can help them understand that, or whether they're getting good advice from the people around them. And then, again, there's a whole bunch of other stuff you have to look at here, but I talked about capital already. I've talked about the market, who's around you. Just keep digging. You want to know who all their advisors are, who's giving them advice. You want to think about how much time you're going to put into this. And then, of course, you have to do legal review. You've got to review the documents. You've got to review the cap table. You've got to review the fundraising documents. You got to make sure that they have, you know, things like employment agreements, all the basics. Now, remember, these are early stage companies, so you have to keep in mind that they're not going to have a lot of things in place because they're early stage, but there's certain sets of documents that they do need to have. And this is the tricky bit, which is why it's always good to work with somebody who's already been doing this, because one of the problems is, and Mike told me to mention this because it's a big problem out here, but apparently it's a problem there too. Sometimes early stage investors put on hats of later stage investors. And so they expect and demand a whole bunch of metrics and a whole bunch of information from early stage companies that either doesn't exist or frankly doesn't matter. And so you got to remember what stage you're investing at, and there's going to be a lot of unanswered questions. And you know, running these guys, and a good example of this is just you know, people who obsess about the, you know, the revenue spreadsheet that shows the hockey stick over 5 years. And every company can build one of those. It's easy to do. You just make a bunch of shit up and put it on a thing so it shows a hockey stick. And frankly, like sometimes early investors obsess over that. And it's like, actually throw that out because it's useless. You won't know beyond a year to a year and a half to maybe 2 years what's going to happen with your company because you haven't even got your product figured out yet. You don't have your marketing figured out. You don't know what your acquisition costs are going to be. So what really matters is what are you doing between now and the next raise, and can you get to that next raise? And so that's where the spreadsheet that shows a year to 2 years most matters. And you know, beyond that, forget about it. So that's just another example. Okay, moving on. Next slide. The other thing that you got to look out for when you're investing in companies is, you know, what their structure and terms are. I don't really have time. We're going to run out of time here. I'm not going to go through this in a ton of detail, but I'll just give you a couple of little highlights. And you'll, if you're really interested in getting into this, you can talk to other people about it. But on structure, it needs to be a B Corp or a C Corp. I will not invest in LLCs. There's just so many problems with them. Some companies start that way and it's a disaster. I've had to convert LLCs to C Corps way too many times and I'm like, I won't do it anymore. So you really want to be looking at whether they're a C Corp or a B Corp. They better have a cap table, and it might be super, super simple in the early days, but you know, with just the founders and maybe a couple of employees with options. You know, if you're doing a first round, but say they've done a friends and family and you're doing the first seed round, you know, you want to see that cap table and you want to know, like, does Uncle Billy have 80% of this company? Because if he does, that's a problem, right? You want to make sure that the founders have enough of the company that they can afford to give some away to raise money over time. You want to make sure there's not 80 people on the cap table and you have no idea who they are. I mean, all those things really matter. You need to pay attention to what types of equity they're raising, and there's a lot of different ways to raise money. Typically, if it's a priced round, you as an investor are going to want preferred stock. Common stock is usually used for the founders and the employees. Investors typically want preferred stock because that means they have preferences in terms of getting money out of the company at a later stage as it exits or IPOs or merges or dies and money's being returned. But most early stage companies raise money either on a note or a safe. And I'm not going to go into all the details on those today, but those are the two instruments that typically as an early stage investor you'll need to know about. Notes, well, and safes too, they have caps, they have discount rates. You need to pay attention to those. So the cap is basically essentially the valuation for the company. So if you're putting money into a company and it's got a cap of $4 million, that's essentially the value of the company today when you're putting this money in. And so that later on in the next round, say it raises money at $8 million, your investment converts from a note into stock at the 4 million price point, because that's the price of, the value of the company at the time you put your money in. There are also discounts, which basically means if money is raised, let's say you put the money in at 4 million the first time and they had to do a down round because things were tough, and the next time around they only could raise it on the 3.5 million cap on their note. Well, you could get a 20% discount off of that cap in order to convert if it converts. And so I'm not going to go into all the millions of examples on this right now. There's one thing to know is there's different tax implications for notes versus safes. So if you're an investor, notes are debt, safes are essentially warrants. They're promise for future stock. And so they start the clock for the qualified small business stock. And that's a whole nother thing that I do not have time to get into today, but there are some advantages as an angel investor, as an early stage investor with taxes and capital gains, that if you invest in an early stage company, you're the first $1 million in, you hold the equity for greater than 5 years, you can also often roll those gains over into another company and not have to pay any capital gains taxes. And there's a million rules around that in terms of which industries it works for, you know, what year you bought the stock, blah, 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 blah. But just know that you should be aware of QSBS and that safes start the clock, that 5-year clock, whereas notes don't, because notes are debt. So the other thing to be aware of is valuation, pre and post. So, and people get these confused all the time. So if somebody says, my company's worth $4 million, your next question should be pre or post. Is that before they raise their money or after they raise their money? So if it's pre, let's say it's worth $4 million pre, and they raise $1 million, post is $5 million. And what they've done is they've given away 20% of their company, because the investors put in $1 million, and that's $1 million over 5 is 20% of what the company's worth post. So that math, just make sure you're clear about whether you're talking about pre or post. Okay, next slide. This is just a sample cap table. I'm going to skip over this. This is a super simple one, but people always ask me, well, what do cap tables look like? They're simple spreadsheets that have all the names of the investors and owners of the equity down one side of it. So the employees, founders, and investors, and then across the columns, it's which kinds of stock do they own? Is it notes? Is it is it common? Is it preferred? Is it warrants? Or is it options, and so on? And every company needs to have one of these. And if you don't see this in the due diligence process, ask for it. Because if they don't have this, that's a problem. Okay, next slide. Oh, I forgot I had this slide. I already kind of covered this. Yeah, so I talked about convertible notes. I talked about safes. And those are the things as an early investor you're mostly going to see. And part of the reason for that is priced rounds are a lot more expensive for a customer or for a company to execute. They require way more documents. There's a whole process for how you price a company that requires more work when you're doing a priced round where you're selling shares of stock. Whereas with a safe and a note, the documents are super simple. They're a lot less expensive to execute. And you quote unquote do have a price in the cap, but you can just set it. You don't have to go through a whole bunch of 409As and all this other stuff in order to set it. And somebody asked the question, are you investing in LLCs or only C Corps? And I only invest in C Corps. LLCs are a nightmare. And that's a whole nother conversation, but I will not invest in them. They have tons of problems. In terms of granting options to employees, in terms of liability coverage. The whole way they're set up is not conducive to venture investing. And the reality is, if this is a venture company that's it's going to have to convert at some point anyway, so you might as well do it early on, because they're a pain in the ass to deal with if they're LLCs. And I won't do it anymore. Some people will, but I won't. Okay, next slide. Because I am behind. So here's some other things you have to pay attention to. And again, I'm not going to have time to do this today in detail, but there are some other things that you're going to hear as an angel. Liquidation preferences, control, investor rights, that you have to pay attention to. And so what I'll tell you just really at the high level, liquidation preferences are essentially who gets their money out first. If there's an exit. And typically the way it works is the later stage investors get their money out first, and those are always fights later on in investing rounds. If the next round is pari passu with the prior round, so they all get their money out at the same time, there's always shucking and jiving and negotiation, but that's essentially liquidation preferences, which is why you want preferred shares versus common shares. That's the other thing. It's like, I won't buy common shares in a company for cash. I mean, I will take them as options if I'm advising, but I will not take common shares for an investment. I want preferred shares. Control provisions. So, you know, you have to watch out for things again. And this is where boards come in. Like sometimes there'll be some weird thing written into the document that says Uncle Bob gets to be chairman of the board. And, you know, you may not want Uncle Bob as chairman of the board. Like all sorts of weird things happen in early stage companies. And so you got to really watch out for those kinds of things. Investor rights. So one of the things I always look for is I want pro rata rights. And what pro rata rights are the, if you put money in, the ability to invest pro rata, depending on what your investment was before, in the next round. And those are really important. And like for somebody like myself, because I do a follow the money strategy where I keep doubling down on the companies that I think are going to do well. So I end up with very large investments in a small number of companies over time. You know, it's hard to get pro rata rights as an angel because usually you got to put enough money in to get them. They usually have, well, you can only get pro rata rights if you put 100K or above in. So those are things you have to argue for sometimes. And believe me, it's worth arguing for them. Okay. Next slide. This is kind of my last, because I'm running out of time here. Second to last slide. Cadence and support. You have to pay attention to where people are in the fundraising process when they're raising money, because you don't want to take investment, or you want to be careful about knowing whether you're taking any investment risk or not. So let's say somebody's raising $1 million and they come and say, hey, we're raising $1 million and we want you in this thing. And you're like, oh yeah, this is great, awesome, I want in. And then you're like, okay, how many other people are in it? Who's soft circled? And soft circled means people who've promised to put money in, but they haven't actually written the check yet. So you want to know that. Like, are you the first person they're talking to? Because if you are, and you say, yeah, you can soft circle me, or if you write them a check, it's even worse. You're going to get sucked into helping them fundraise because they have to get to their goal. So like if you write a check early in a fundraising round, before they know they can even get, let's say they've got 250 soft circled, I'm writing them a check for 50K, they need to raise $1 million. I'm taking all sorts of fundraising risks because A, they might not even get their 250 because it's just soft circled, it's not in the bank. And secondly, where's the 750 coming from, right? Who's going to help them raise that? And so this is where, I don't recommend this when you're first starting out, but lead investors, like if you become a lead investor, you're typically responsible for helping them get the rest of the fundraising done. And that's where, experienced investors and can really help companies close that gap, find other people, bring other people in, and so on. But you need to be aware of where you are in the pecking order. And, you can say, I'm going to give you money, but I don't take investment risk hardly ever unless I'm the lead investor. And I'll basically say, I'll give you 50K or 100K, but you got to raise the rest first. So pay attention to that because that will change the risk that you take when you make investments in a company. And then, sometimes they'll do multiple closings where you might not be in the first closing, you might be in the second closing. Typically it's one closing in a seed round, but sometimes it gets drug out, especially in places like Seattle where it takes forever to raise money. And then usually you'll get the docs and you'll have a chance to review them, the fundraising, the notes, the documents, and then ideally you want an attorney or to look at those. So highly recommend if you're just getting started to have a good accountant and have a good attorney that you can share documents with and have them just do a quick skim, because a good attorney who works in, not just random attorney X, an attorney who works in this space, because they can look very quickly at a document and see if there's anything that's abnormal. Because what you're looking for is like, these are standard, notes are standard, safes are standard, they're all standard documents. They're like literally push a button standard. But every once in a while, people will slide some weird thing in there. And attorneys are really good at picking those things out and going, wait, that's a strange provision. You need to go back and question that. So you need to have time to do that. So, I never, like, once in a while a company will be like, well, I need you to sign today. And I'm like, well, I don't do that. I need at least a week to look at documents before I'll sign them. unless they're super, super simple. And so that's basically the end of my presentation, except for the Michigan part, which I'm going to get to. But the comment I just want to leave with here is, I just threw a ton of stuff out. And some people, when they first see all this, they just go, holy shit, man, this is way too complicated. I don't understand this. I'm scared. I don't want to do this. And what I would say to you is it's actually not that hard, and it's actually a lot of fun. And the way to do this, if you're just getting started, is to do it with other people, especially if you can find some people who have some experience, whether it's in an angel group or it's just some individual angels or somebody in a venture firm who's willing to work with you that's doing seed investing. It's actually not that hard if you can work with other people, and you'll pick it up really, really, really fast. And so it kind of sometimes can seem overwhelming, but it's really not. And I would say, you know, like Mike said at the beginning, I can't emphasize it enough. We need more angels, especially in Michigan. And we need more women. We need more people of color. Like we need diversity, and we just don't have even remotely enough. And so if you have any inkling about doing this, it's like one of the best things you can do if you're willing to get into this asset class, is become an angel investor, because you can actually have a really, really big impact on on bringing new technologies and new ideas to the world, and ideas that matter to people like you, not just to certain people. So on that note, last slide, Michigan resources. Here's a slide with a bunch of resources in the state of Michigan where you can go look for other people who might be investing. The first thing I would say is go talk to Mike Sorothakis at the Venture Center. Those guys are unbelievably amazing. They have deep resources there. They know what they're doing. And if they can't help you directly, they can point you to other people. So I highly recommend that you start with the Venture Center and Mike. There's also a Michigan Venture Capital Association. And that second link is a whole bunch of funds that they have. So oftentimes you can find angels by other angels and stuff by looking at who are their LPs, or maybe getting and working with one of them on the side. That's what I've done sometimes with venture firms. There's a bunch of angel groups in Michigan. You can always get plugged into one of those. That's a great way to start too. And then there's national associations. And then the last thing I'm going to say before I stop here is Mike mentioned at the very beginning that they just got the Accelerate Blue Fund off the ground. And I am so excited about that fund. This has been like decades coming. Like we've wanted Michigan to do this for so long. And Kelly Sexton and Mike Sorothakis and a whole bunch of other people at Michigan and other parts of the university too work together to get this thing off the ground. It's super, super exciting. So what I'm saying to you as a potential investor is if you're thinking about getting into this asset class, this is not an either or. Like there's a lot of different ways to get in, and this getting in this way is one way, one possible way, and it's set up in a really unique way. It's philanthropy. So you write a philanthropy check to this fund. And so you'll never get return on it. So this is not about building a portfolio with return. This is about you giving. But it's about you. So you can think about this in terms of, that's why I had that giving pool on the right-hand side of that original slide, because a lot of people are thinking about where do I take money from? One thing to consider is to take money from your giving pool and give it to that fund, because that fund is investing in for-profit startups. And so when they're successful and they get exits, all that money's coming back into the fund to continue to build the ecosystem and invest in more companies. So if you write a check into that fund and these guys are successful, which they will be, it's like you keep on writing checks, but you don't have to keep writing checks. They're doing the work for you, right? So you're essentially, once you put money in, it just keeps on giving as long as they can get returns on their investments. And when I look at these guys, I'm like, oh my gosh, okay. It's like every fund's dream. They've got, they've got an incredible deal pipeline of amazing companies coming out of the University of Michigan, not only, not only deep tech, but also ideas from all over the university. They've got a huge team of experienced people who understand venture and understand investing and know how to work with startups because they're already doing that through the Venture Center. Plus, they got the entire University of Michigan, which has people in like every area of expertise connected to every imaginable company and government entity. Like somewhere inside of Michigan, there's somebody who's got the right contact for you if you're a startup. And these guys are like, on your cap table and they're trying to help you. You couldn't ask for better resources. Plus, there's, I think, over 640,000 alums. I think we have the biggest alum network in the world. And so again, more resources, more people that can be plugged in to make startups successful. So when I look at that fund, I'm like, if I'm putting money into a fund, that's a place to do it. And as an angel, if you put money into that fund, in addition to possibly being an independent angel or getting involved in an angel fund where you're working on the diligence together or whatever, putting money into this fund plugs you into deal flow and people who are doing this and really building the ecosystem. So that's my personal pitch for consider putting money into that fund, because I just think it's going to do great things for Southeast, particularly for Southeast Michigan, but for anything coming out of the University of Michigan, and will help you as a potential angel investor get into this asset class, get plugged into deal flow, and get plugged into people who know how to do this stuff. Okay.
Wow. Thanks, Serena. That was an amazing ending. Thank you so much for. So I have
3 hours, not an hour and 40 minutes.
Well, and I will tell everybody who's still watching, and really I appreciate everybody who's attending. The numbers are pretty good. Serena has done this for 3 hours for us today because she earlier gave a presentation on how to raise money from angels. So it's been a long day for her, and again, I just have to reiterate the support and advice you've given us, and we're clawing our way to getting the fund stood up, hopefully. And I do hope, I think early next year is the goal. We're trying to raise, we're trying to raise 20 million, but we're going to start investing once we hit 2. So for those who are interested in finding more, obviously we'd be glad to talk with you, as well as point you to the right resources and people if you do want to become an angel investor, not just in University of Michigan startups, but any startup, because the more activity we have for that, the better it'll be for Michigan as well. So we do have a couple more minutes, so I'm going to ask you one more question. And I'd like you to talk a little bit more about expanding the pool of angel investors and the diversity angle there, as to there's challenges in this industry in fighting against in making it more diverse, and so someone who doesn't have the ecosystem where they can tap into people like you, so other potential women investors or people of color who don't know a lot of people, first, please reach out to our team. We'd be glad to help, but people might not be comfortable because they don't know us. So what's your suggestion for tipping their toe into just learning, besides obviously going on the internet and and actually thinking about and doing this seriously?
Yeah, no, great question, Mike. And it's a we're all working hard to kind of change the dynamics in this industry. And when I first started, like I said, the people helping me, they were all guys, right? Literally, because there were very few women angels. So the only way to figure it out is just to get in and do it. So I'm kind of a big believer in, you want to be smart and have your eyes open. And I think, there's so much information available out there on the internet today and through stuff, like these kinds of presentations and stuff. I mean, I didn't even know a fraction of this stuff when I started. So I'm not saying just start throwing money around. You want to do it, you want to have, you know, a way of, you want to understand what you're doing, but you kind of, you can't tiptoe around. You just got to get in and do it. And so if you're, you know, especially if you're female or a person of color and you don't have a personal network around you, which is often the problem, you know, with women, for example, you go join an angel group.
Yeah.
Right. You just, and you know what? 95% of the people in the room may be guys, but start learning. That's the only way you're going to do it. And then what happens is you'll start finding others, because there are other women out there. There are other people of color out there. There are a lot more seed funds out there now than there were even 5 years ago. We not only have diversified staffs, but are focusing on diversified companies. So they're out there. You may have to work a little harder to find them, but get out there and network and find them, and just piggyback on to whoever. And, you know, it kind of doesn't matter who you learn from, as long as they're experienced and they understand what they're doing, is learn. And then you can start saying, okay, I am only going to invest in companies that, you know, have certain diversity profiles or have other women on the board or whatever. And then you'll start meeting those women or those people of color. I mean, it'll just start naturally happening. But for anybody, the only thing I can say is you got to just get out there and do it. And it's going to be hard, but it's going to be easier now than it was 30 years ago or 20 years ago, for sure.
Yeah. And I know many of the groups, while they may charge fees to join them or have minimum commitments over a certain time period, for new investors, they're usually very welcoming in letting those people, you know, get on board and learn before they make those kind of commitments. So
yeah, absolutely. A lot of these groups have diversity criteria of their own, so they'll work with you. And you know, I wish I could just pop the name out of one that, you know, was like, oh, go join X. But you know, like on the founder side, so I did do a fundraising, how to raise money thing earlier today, and one of the things I brought up was the Female Founders Alliance. Like, if you're a woman CEO or non-binary CEO, like, and it's nationwide, get in the Female Founders Alliance, because those guys are amazing. And they're here actually in Seattle. It started here, but it's nationwide now. And oh my God, the level of support that they provide to female and non-binary founders is amazing. And so those organizations are starting to exist. And, you know, even, you know, if you plug into one of those, like if you're looking for deal flow, you're a woman, you're looking for deal flow, plug into the Female Founders Alliance, because you'll find diversified teams, but you'll also find CEOs who have raised money from other firms or other angels who are not white guys, right? So you just got to get in those networks and start looking. And nothing wrong with white guys, Mike. You're awesome. But you know, we do need diversity, because, you know, it really makes a huge difference on boards, especially. It's like, and in the C-suite, because it's like, if you have people around you who look more like your customers, you're probably going to do a much better job of serving those customers. You know, because you're going to come with different life experiences and different points of view on what people need or want, who are different from you, you know, founder, or you co-founder, whatever. So it's important. The diversity thing is really, really important.
Yeah, and you said this before, but the data is a slam dunk now.
Yeah.
That those companies do better.
They do. I mean,
and the firms that are investing even at the venture level, they're doing better, because the point of view gets everybody outside of a box that we all put ourselves into. So
that's right. That's right. Companies that are diversified, the problem is you get blind spots. And, you know, I've got a couple out here that I'm just like, oh my God, you know, they're just so blind, because the people, they all look the same. They all came from the same socioeconomic status. They all came from the same place. And I listen to them sometimes and I just like want to scream. I'm like, you guys are so inside your own little heads here. And part of the problem is they don't have other people there telling them, well, wait, no, the rest of the world doesn't quite work like that. You know, so it's important.
Yeah. Well, we have taken enough of your time today. Again, Kelly and I can't thank you enough for what you've done today and for the 6.5 years I've been here. I don't think, to be honest, I could have done it without some of your counseling in the early days, especially. So,
You guys have been awesome. You and Kelly both.
oh, well, thanks. But
Team. I'm like, you guys have gotten more stuff done in the last couple of years. I'm like, wow.
It's been a record year for us. Check out our annual report for those who haven't seen it yet. The numbers are public now, and it's been amazing, especially given the last 3 years
Brilliant.
were tough. So we're fortunate, and we're riding a great wave. And again, thanks to everybody who's joined us today. If you have any questions or follow up, please reach out to us. And with that, all of you be well, and of course, go blue.
Go blue.
Take care.